in the past, and based on that, create buy-sell signals. Some people claim that they can make a lot of money using that. Maybe for a short period of time they could. The trouble with that argument is you are not the only smart person out there. Okay, if you could see a pattern and exploit that pattern and make money, what's to stop other people exploiting the same pattern? We did look at uh, the performance of small caps over time, right? I don't know if I did this in this class or the investments class. Okay. We didn't. Yeah, I did it in the investments class. Uh, in fact, that's something we're going to look at next week. I'm sorry, not next week, on Wednesday. But historically, if you do the following exercise, at the end of each June, you sort the stocks based on their market cap. Let's say there are 10,000 stocks, and you buy 1,000 smallest stocks, market cap weighted, and you short 1,000 largest stocks, and you keep that position for 1 year. Then 1 year later, you repeat this exercise because companies change their size over time. If you had done this over the last 100 years or so, on average, you would have made a return of about 7% a year. By the way, this is a zero cost investment strategy. Yes, normally they would charge you margin and stuff, but small cap stocks historically outperform the large cap stocks by about 6% a year. And large cap stocks historically made about 12% a year. And you're probably thinking, why isn't everybody buying the small cap stocks? It looks like it's a violation of the weak form efficiency, right? Because I'm using only past price information, nothing else. I don't know anything about the market profitability of these firms. I don't know anything about risk measurements. Nothing. All I know is what was their value, market value relative to the large stocks. That's it. Based on that alone, over the last 100 years, small caps outperformed the large caps by about 6%. Now, if you repeat the same exercise since 1971, when the NASDAQ first opened, versus 1925, the oldest price data we have available, since 1971, that differential is only 3%. It's no longer 6%. In fact, if you done it since 1991, 1991 was the year Eugene Fama and Ken French published their study about this. And in fact, they even started a small cap fund like that. They actually put their money where their mouth is. They started a fund that actually did exactly that. And that differential is only about 2%. Small cap stocks are still doing better, but it is no longer 6%. And if you made those calculations on a risk adjusted basis, there is no more difference anymore. Why? Because people caught up with the strategy. I mean, the professionals always knew in 1950s and 60s, 70s, if you bought small cap stocks, on average, you did much better. But individual investors knew nothing about that. You know, but once people caught up with that, they said, okay, I'm going to buy the small cap funds instead of large caps. Well, suddenly the demand for small cap stocks goes up, demand for large cap stocks goes down, which means the expected returns on small caps is going to come down, and expected returns, relatively speaking, of course, on the large caps is going to go up, and that thing is going to disappear. Same thing happened with value versus growth. You know about the Oracle of Omaha, right? Warren Buffett. Uh, Warren Buffett's secretary, when he first started, didn't get paid much. He paid him in stocks. She hasn't sold any of it. I think she's worth more than $100 million now. Why Warren Buffett always buys so-called value stocks instead of growth stocks? Value means typically low PE ratio or low book to market ratio, all right? Or low market to book ratio. Growth companies are companies like, Microsoft, Nvidia, Google, and so on and so forth. Again, if you did this sort of experiment over time, we have data on financials available since 1963 or so, basically over the last 60 years or so. If you bought the 10% of the companies with the highest, uh, lowest market to book ratios, those are the value companies, versus shorted uh, the other end, the growth companies, on average, you made about 4% more. Again, if you repeated the same experiment since 1991, that differential is also uh, by half now. It's only 2%. You can still make a little bit more money using value stocks, but not as much. Okay? So just because something historically is there doesn't mean it's going to keep being there. And one of the reasons it's there, when we make these calculations, we make these on a hypothetical portfolio. That hypothetical portfolio never pays any brokerage fees because we don't know what sort of brokerage we have, and it doesn't go through any bid offer spreads. Obviously, bid offer spreads on small stocks are higher, and in the old days, you pay a lot more in commissions for smaller stocks compared to larger stocks. So maybe some of that was explainable due to transaction costs. So there was a lot of research that said markets are not efficient because they can have these. I'm not sure about that. Because if that was indeed the case, uh, the amount invested in the small cap funds should be pretty high. Let's look at an example. There's a small cap ETF, I think it's IWM, if I'm not mistaken. Yeah, this is iShares Russell 2000. Uh, Russell is an index that normally has 3,000 stocks. Russell 2000 looks at the 2,000 smallest stocks in that index. Let's look at how much money is invested in there. It's not that small, 214 billion. Okay, and let's look at the large cap version. I think it's IWF, if I'm not mistaken. No, it's been a while since I did anything with these. Not Russell, Russell. I couldn't find it, but or we could look at IW. I'm looking at the wrong place. It's Russell 1000 value. That means largest stocks that are value stocks. 200 billion invested in those. This is Russell 2000 value, 161. There isn't too much difference between them. So markets doesn't say, you should go ahead and do that. This is in a sense, I always view this as revealed preference of the market. Market doesn't say that we're gonna go ahead and do all of these. Yes, over a long period of time, you'll probably make more money, but the risk of that is going to be much higher. In fact, on Wednesday, we're going to look at the historical performance of those. Not only we're going to look at the average returns, but we're going to look at the standard deviation of those returns. I'm going to add one more seeming violation of those, the so-called momentum effect. So if you buy the winners, past winners, you make more compared to buying past losers.